All right, let's dive right into this explainer. Today, we're doing a clinical, top-down forensic breakdown of the EURUSD setup. And we're not just guessing or using intuition here, we're relying entirely on the mathematical precision of the Protocol BBROTHER FX version 1.0, specifically its universal engine. We're going to use pure data, price structure, and the clear institutional footprint to decode exactly what's happening behind the scenes. Let's get to it. Here's our game plan for today. We'll establish the macro context with a vision protocol, decode the Wyckoff and Elliott structures, track the institutional footprint through volume and COT data, run an SMC liquidity audit, and finally, lock in a highly disciplined execution strategy. Section 1. The Vision Protocol. Let's establish our algorithmic battlefield and the baseline metrics for the euro against the US dollar. Anchoring our analysis to the daily chart, the current price is sitting right at 1.16064. Now, based on the protocol's numeric scan, this places the asset squarely in the discount zone of the distribution range. Mathematically speaking, it's sitting below the range equilibrium of 1.1765 and above the absolute macro low of 1.14499. So taking the bigger picture into account, we are in a highly favorable environment for looking at sell opportunities or taking profits. Moving into Section 2, the Wyckoff and Elliott structure. This is where we decode the geometric price action using strict pattern recognition. The focal point here is the absolute peak at 1.20816, defined with pixel-perfect precision as the upthrust UD. Now, this isn't just some random high. It's the ultimate algorithmic climax of demand. It's literally the footprint of retail buyers totally exhausting themselves, which confirms we are locked into a Wyckoff Schema 2 distribution. It's the exact moment institutions finish selling into the retail buying frenzy. And when we layer in Elliott wave theory, the geometry gets even clearer. Following that daily 5-wave impulse phase, the system confirms an unfolding 5-3-5 zigzag correction. So we had the impulsive wave A, the 3-wave correction for B, and right now, we're right in the middle of a highly impulsive downward wave C. The direction is literally dictated by the geometry of the market itself. Section 3, the institutional footprint. Structural geometry is great, but we absolutely need to validate it with volume and macro data. Okay, so here's where the volume divergence becomes glaringly obvious. From a retail perspective, there was virtually no demand, really low volume, during that rally back up toward the last point of supply, or LPS, at 1.18260. But look at the smart money perspective. They unleashed massive volume and heavy sell pressure on the downward moves right after that upthrust. Basically, smart money is aggressively selling into every retail rally attempt. Now, if we cross-reference this descent with the latest macro commitment of traders data from the CME, the institutional bias is undeniable. Sure, non-commercial funds are technically still net long overall, but look at the recent dynamic shift. We're talking about a staggering surge of nearly 16,000 new short contracts being added, completely eclipsing the long additions. Combine that with a drop in overall open interest, and it's pretty clear we're witnessing a massive capitulation of long positions. Because of all this heavy data, the BBROTHER protocol unequivocally flags this macro sentiment with a clear status: bearish institutional. It assigns this a high probability grade. Make no mistake, the institutional wind is blowing aggressively to the downside. On to Section 4, the SMC and liquidity audit. Having confirmed the macro intention, let's isolate the specific algorithmic zones engineered for institutional re-entry. The smart money sequence here is incredibly strict. First, we got a clear change of character and break of structure below 1.16500. Second, a complete sweep of the buy-side liquidity resting above the upthrust at 1.20816. They took out the early sellers. And third, price is now slowly returning to retest that premium zone made up of a validated order block and an immediate price imbalance. It's the perfect trap. Let's talk about the liquidity engine. We have a fair value gap sitting right between 1.17000 and 1.17300. This gap acts like a giant magnet for institutional re-entry. And why? Because it aligns perfectly to target that massive pool of resting sell-side liquidity, sitting incredibly vulnerable just below the 1.14499 macro low. That is the real target. That's where the real money is resting. Finally, Section 5, execution. This is where we transform raw analytical data into a highly disciplined emotionless trading machine. According to the inviolable rules of the BBROTHER FX protocol, we get a mandatory directive here. Risk/reward optimization is required.
The system doesn't tolerate mediocre entries. To ensure institutional-grade profitability, every single parameter has to be calibrated to the decimal.
And the result of that calibration is this critical number, 2.38. By anchoring a pending limit order strictly within that identified fair value gap, the system automatically locks in an optimized risk/reward ratio of 2.38. That easily clears the mandatory 2.0 elite threshold. Basically, you're risking 1 to comfortably make 2.38. That's the only language long-term profitability speaks. So here is the exact mathematical blueprint. We have a sell limit order placed precisely at 1.17000, right at the edge of the imbalance. Our stop loss, our defensive shield, is anchored mathematically at 1.18260. That places it strategically above the LPSC zone, totally safe from noisy retail stop hunts. And the take profit? Dialed in at 1.1400, specifically designed to sweep that ultimate sell-side liquidity target. But hey, we're dealing with probabilities here, so what invalidates this entire structure? Leaving absolutely zero room for subjectivity, the hard invalidation scenario is a decisive daily close above the 1.18260 LPSC. If that level breaks, the entire distribution logic is dead. So you have the raw data, the exact geometry, and the institutional footprint all laid out in front of you. The question isn't whether the market is manipulated, it's whether you have the discipline to trade alongside the ones doing the manipulating. Until next time.